Hello again, everyone. You're listening to Cheryl Morford, who is the module leader for Financial Management 2A. So like I did for your test one, I'm going to do 3 recordings for you now, 2 of them from Learning Unit 3 and 1 from Learning Unit 4, in which case I'm going to deal with break-even and linear programming so that everybody's going to be super well prepared for test 2, which is coming up at the end of this following week. Right, so I'm going to start with a single product break-even type of a question. So I'm going to share my screen with you. Right, here we go. This is just something that I have put together to be able to include multiple scenarios on different things. So you should remember from Financial Management 2A, because you did break even there. But we're just going to add a few little twists and turns, tweak it here and tweak it there. But I'm sure you should find this section quite nice and quite simple, actually. So let's have a look here. In my initial scenario, we're going to say these are the facts. Total fixed cost 72,000, variable cost per unit is 12, selling price per unit 24 Rand, and the budgeted sales 9,600 units. So you should remember how we're going to calculate our break-even units. It's as it was before in FINM 2A. Just a reminder on how it goes. Our break-even units is equal to our total fixed cost divided by contribution margin per unit. Don't forget that another term for contribution is marginal income. It means the same thing. So just let's take our values. See how easy this is? Our total fixed cost is the 72,000. Our selling price is 24 Rand, from which we subtract 12 Rand variable cost, gives us contribution per unit or marginal income per unit of 12. Divide into 72,000 and we're going to get 6,000 units. It's important here that you do say it's units. In the event of it not being a nice, convenient whole round number like that, what do you do with all of your break-even units? You always, no matter what, are going to round up. Even if you had, let's say, 502,1 units, you always round it up, because until that last unit is actually made, you haven't covered all of your cost. In other words, you haven't broken even. Then another typical question is, what is your break-even sales revenue? So I'm just going to remind you there of what that formula is. It's going to be our break-even units, and we're going to multiply that by selling price per unit. That's the simplest way. So 6,000 units times 24 Rand is going to give me an amount of money of 144,000 Rand. So you see here in the first part, it is units, but here it must be Rand. There's also another way of being able to calculate your break-even sales revenue, and that is by using the marginal income ratio. Okay, I'll show you how both of them work. Another word, obviously now for marginal income ratio, it could be your contribution to sales ratio. Let's just abbreviate that. Contribution to sales ratio. Because remember, contribution and marginal income mean the same thing. So all we're going to do here is we're going to take our contribution of 12 Rand and find it as a percentage. This is the difference of the selling price. So if we're wanting a formula over here, it's going to be our marginal income or contribution margin divided by selling price times 100. That will give us your marginal income ratio. I'm going to show you now here how we could work out our break-even sales revenue if they didn't ask us to find the break-even units first. So what we're going to do here, we're just going to do an OR. What else could we do? It could be our total fixed cost, and we can divide that by the marginal income ratio, which is equal to, remember the fixed cost is the 72,000, and our marginal income ratio is 50%. So divide by 0.5, and what does that give us? Exactly the same amount, 144,000 Rand. So just take note of both options. I've deliberately picked a simple, straightforward question so we can focus on the concepts and you understand what we're actually doing. Then, should you get a more complicated question, so long as you understand what you're doing, then it's going to be much easier. Right, so the next thing is we don't always just only want to break even. Businesses are in business to make profit. So what about if we're going to be given a profit target, and let's say it's given before tax? So not only now do we need the contribution on a unit to cover the fixed cost, but we also need to be able to make and sell sufficient units to generate that profit of the 36,000. So you see what we do over here. We go and we take that profit and we add it to the top. So it's the fixed cost plus the before profit tax gives us a total amount of 108,000, pardon me, that we need to have enough units to cover. So once again, we're going to divide that by the contribution, and we're going to find we get an answer of 9,000 units. So once again, it's units. And what do you notice over here? The number of units that we need to generate a profit must obviously be bigger than the break-even units. So I'm just going to type that there. Your profit target units must be greater than your break-even units. If they're not, that should cause an alarm bell to ring in your head and say, uh-oh, problem here. Let me go back and sort out my break-even units. Because you can never have profit target units being less than break-even. So here, that's an additional 3,000 units. Let's just amp it up a little bit more. And what we're going to do here, it's the same thing. It's going to be a units for profit target situation again, but this time, what if the profit target is given after tax? So, as you should know by now, all calculations must exclude the effect of either VAT or company tax. So what we are talking about here, that's also worth considering, is the tax we're talking about is corporate or company tax. We are not, please, going to be mixing it up with the sales tax, which is VAT. It's company tax. And we're going to use the most recent relevant rate, and the company tax or the corporate tax rate that we're going to use is equal to 27%. Sorry, I just put the wrong sign in there. Equals 27% of taxable profits. So see what I'm going to do now. I'm going to take my 30,000 here, And what am I going to do with it? I have to convert that because it's after tax. I must convert it to before tax. So it's just using the ratio. So that 30,000 represents 73% because the other 27% has been taken off. So to raise that up to before tax, or the 100% amount, we must just divide it by 73%, which, as you know, is 0.73. The one thing that you cannot do is go and find 27% of 30 and add it on, because the mistake there is you're finding 27% of the amount, which is already excluding the 27%. So that's the only way to do it. Like I've shown you. So now we have a much larger numerator here of 113,000, which when we divide by the contribution of 12 Rand gives me 9,425 units. What else could they possibly ask? Concept of margin of safety. This is a nice, short, easy little section. We can either have the margin of safety in terms of units or as a percentage. So what this means is the level below which sales would need to fall in order for us to move into the loss area. So how can we find this? It's the difference between your budgeted sales and your break-even units. So it's almost like the insurance plan or the buffer, the extra, in case. In case you have a downturn in sales, what is the lowest level that sales can drop to before we start to incur a loss? That's called margin of safety. So how do we calculate it? We just type in what we're doing. It's our, let's just abbreviate, our budgeted sales volume, from which we're going to go and subtract the break-even units. So we need to pop up here to my scenario. Here we go. We've got budgeted sales, 9,600. We've worked out in the initial scenario, our margin of safety is going to be as follows. We're going to subtract the 6,000 break-even units from the 9,600, and we get 3,600 units. So that's what you do if it's units. Now we can turn it into a percentage. So all we're going to do is we're going to take those, type it over here, the margin of safety units, and we're going to go and divide that by our budgeted sales volume and turn it into a percentage. So that's all there is. 3,600 as a percentage of 9,600 is 37.5%. Now, let's play around a little bit. This is known as sensitivity analysis. So we can start to change any of the variables that are part of the calculation and see what that does to profit and to break even and all these things. So I'm just going to do two possibilities here. I'm going to take my total fixed cost and let's make that bigger. So let's increase it by 8,000. And let's also take my variable cost per unit and let's reduce that by 2 Rand. Also make sure that you could deal with this in a more applied context. So that means that you're going to have to know the components of total fixed cost. You type that here. So you must know your fixed costs from the variable costs. So fixed costs are going to be things like advertising and those sorts of things. Variable cost is any kind of material, direct labor, or any item, cost item that increases or decreases as your units produced or sold increase or decrease. So if we're going to have fixed cost increasing by 8,000, what are we going to do? We're going to take that 8,000 and we're going to add it to our initial 72, gives us 80,000. Notice over here, because the variable cost has changed, what do we need? Let's do another NB. We must now go and find the new contribution margin per unit. So any change in either selling price per unit or variable cost per unit is going to change your contribution. So if you're needing to work out break even, best you go straight away and find your new contribution, which in this case is going to be the same selling price of 24 Rand, but instead of minusing variable cost of 12, we're going to make it only 10 because it's reduced by 2. So that is then going to give me 5,715 units. And that's that. That's all we really need to have a look at again in terms of single product break even. So what I want to do now is end this recording and make another one on aggregate or multi-product break even.